Inflation reduces your purchasing power. If inflation is high enough, a positive return can turn negative. If inflation reaches 6%, your bond's real return goes negative. Buffett has long pondered inflation. The legendary 91-year-old investor had the dangers of inflation drilled into him by his Republican congressman father, according to biographers. Here is Warren Buffett: How to make money during inflation. In light of the recent sharp increase in prices, it is worthwhile to take another look at some of Buffett's most insightful recommendations for combating what he has in the past referred to as a gigantic corporate tapeworm. 1. Invest in good businesses with low capital needs. Buffett has long advocated for the ownership of businesses that generate high returns on the capital that is invested in the business. During periods of inflation, companies that have low capital requirements and are able to keep their earnings stable should fare better than companies that are forced to invest more money at ever higher prices just to keep their position. Buffett once described the difficulty of dealing with inflation as being comparable to running up a down escalator. 2. Look for companies that can raise prices during periods of higher inflation. In 2010, Buffett provided testimony to the Financial Crisis Inquiry Commission in which he stated that the single most important decision in evaluating a business is pricing power. You have the ability to raise prices without risk of losing customers to a rival company, and you can run an extremely successful enterprise. A company that is able to raise its prices has a significant competitive advantage during times of high inflation because it is able to offset the impact of inflation on its own growing costs. Buffett once stated that in an inflationary world, the ideal asset to own would be an unregulated toll bridge because by that point, the bridge would already exist and the owner would be able to raise tolls to compensate for the effects of inflation. He explained that if you build the bridge using old dollars, you won't have to keep replacing it in the future. 3. Take a look at TIPS. Treasury Inflation-Protected Securities, more commonly abbreviated as TIPS, are yet another investment option that Buffett recommends to investors who are anxious about the prospect of rising inflation. TIPS provides investors with a fixed interest rate on a semi-annual basis. However, the principal amount is adjusted for inflation on a monthly basis based on the Consumer Price Index. 4. Invest in yourself and be the best at what you do. According to what Buffett told his shareholders, one of the best ways to keep your purchasing power stable over time is to make investments in your own talent. The best surgeon or lawyer in a city or town has the advantage of having received an education that was purchased with old dollars, but they are also able to price their services in current dollars without needing to re-educate themselves. Consider enhancing your chances of getting hired by adding a new qualification to your resume through the pursuit of additional education at a nearby university or through the use of online resources. The pursuit of advanced degrees can be expensive, but they can also help you expand your knowledge base and make you an indispensable employee in the future. Increasing your value to your employer and the company's customers will enable you to command a greater share of the company's earnings over time. 5. Steer clear of traditional bonds. In his letter to Berkshire's shareholders for the year 2020, Warren Buffett stated that bonds are not the place to be these days. Bond investors might take a significant financial hit in an inflationary environment due to the fact that interest rates are still relatively low compared to historical averages. According to Buffett, investing in a bond with a 10-year maturity and a yield of 2% is equivalent to paying 50 times a company's annual earnings to acquire it. The primary distinction between the two scenarios is that the earnings on the bond won't increase over time. According to what he had to say, the future is looking bleak for fixed income investors all over the world, whether they be pension funds, insurance companies, or retirees. 6. Limit your wants. Charlie Munger, who is Buffett's business partner and the vice chairman of Berkshire Hathaway, has his own unique perspective on the most effective way to deal with times of high inflation. When speaking to shareholders of Berkshire Hathaway in 2004, Munger advised them that one of the greatest offenses to being worried about inflation is not having a lot of silly needs in your life. In other words, if you haven't created a lot of artificial demand to drown in consumer goods, you have a considerable defense against the vicissitudes of life. Think about using a budgeting app to keep track of your expenses so that you can get a better handle on the situation. This will assist you in understanding how you are currently spending your money and may assist you in identifying potentially problematic spending bursts before they become a habit. What about gold? Gold, which is a commodity, is commonly thought of as a way to keep money or make money during times of inflation. However, this is not always the case. A potential buyer of gold needs to think about not only buying the precious metal, but also how to store it, the fluctuation of its price, and the opportunity cost. When compared to other methods of making money, investing in stocks or treasuries might be considered the more reliable choice. Notably, Buffett has chosen not to invest in gold, which is an asset that is frequently considered to be an excellent inflation hedge. Gold investors are particularly concerned about the effect that inflation will have on paper currency, and Buffett shares this concern. However, he made the following observation back in 2011. If you own 1 ounce of gold for an eternity, you will still own 1 ounce at the end of it. He would much rather invest his money in productive assets, such as stocks, real estate, or farmland, which provide their owners with dividends, income, and even food for themselves. Recently, a number of people have begun referring to cryptocurrencies as the digital version of gold, but Buffett views these investments with the same level of extreme skepticism. Bitcoin has no unique value at all, he told CNBC. It does not result in the production of anything. You could stare at it all day long, but nothing like tiny bitcoins or other digital currency would come out of it. To put it simply, it's an illusion. Warren Buffett inflation advice. Everyone in the United States would be extremely happy if $1 million were to suddenly appear in every home, with the exception of those who have investments in dollar-denominated assets, according to Warren Buffett. In an inflationary environment, the worst thing to hold is a currency with too much supply. Buying power declines hurt savings, bonds, and low-interest money market accounts. Buffett invests idle capital during inflationary times. Buffett doesn't try to predict future inflation. He looks at the current rate and trends and adjusts his portfolio while sticking to his long-term value investing system. Companies without pricing power to cover rising production and labor costs should be avoided. If a company can't raise prices without decreasing sales and volume, they lower their profit margin percentage and overall profitability in dollar terms. Companies that can't pass on their own inflation to consumers can go bankrupt if they don't have enough capital or credit to extend loans as their profits evaporate. Unfortunately, the vast majority of companies will not fare well in terms of their real finances when inflation is present. They may see an increase in their earnings over time, but in order to maintain the same level of financial stability, they have to continue to invest a growing portion of their income in the company. The worst kind of business makes you put more money on the table but doesn't pay off. Buffett is explaining that businesses that have low returns on tangible assets have a difficult time generating a return on equity because they are required to reinvest all of their profits in the company, and have a difficult time generating capital expenditures for the purpose of upgrading equipment and investing in growth. These are the types of businesses that cannot function without making significant investments in the purchase of raw materials and inventory. As a result, they have high upfront capital requirements, are completely dependent on the terms offered by their suppliers, and have no control over the prices they are charged. What do you think of our video? Let me know in the comments section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.